Everyone throws a party the day they pay off their house. Nobody throws a party for what it actually cost them. Paying off your mortgage early feels like the responsible thing to do. It feels safe. It feels like winning. And in a lot of cases, it's actually the expensive choice dressed up as the smart one. I'm Frank. On this channel, we don't chase getting rich fast. We do the math on getting wealthy slowly. Today, I'm going to show you the math nobody runs before they make this decision, and when paying it off early actually is the right call. Ask anyone if they'd rather owe money or owe nothing, and almost everyone picks owing nothing. Debt feels like risk. Being debt-free feels like safety. That instinct isn't wrong exactly, it's just incomplete. Here's what that instinct doesn't account for. Every extra dollar you send to your mortgage is a dollar that stops being available to do anything else, including grow. Yeah, let's actually run the numbers. Every extra payment toward your mortgage earns you a guaranteed return, equal to your interest rate. If your mortgage rate is 4%, paying it off early is like earning 4%, guaranteed tax considerations aside. But if that same money invested in the market would reasonably earn 7% over the long run, you're not choosing between debt and no debt. You're choosing between a 4% return and a 7% return. That gap, the difference between what your mortgage costs you and what your money could have earned elsewhere, is the part nobody puts on the "we paid off our house" social media post. Let's make this concrete. Say you have an extra $500 a month and a mortgage at 4% interest with 20 years left. Put that $500 a month toward extra mortgage payments and you'll pay off the loan around 6 years early, saving roughly $40,000 in interest. That sounds great, and it is great, but invest that same $500 a month at a 7% average return over those same 20 years, and you'd end up with more than $250,000. Even after accounting for the mortgage interest you didn't save, you'd still come out tens of thousands of dollars ahead. The house paid off version feels better. The math says the invested version is worth more. Here's something that changes this entire conversation depending on when you bought your house. If you locked in a mortgage rate back in 2020 or 2021, when rates dropped below 3%, this math isn't close. Investing almost always wins by a wide margin because the gap between a 3% guaranteed return and a 7% expected return is enormous over time. But if you bought more recently, when rates climbed well above 6 or 7%, the picture flips. At that point, paying down the mortgage early might genuinely be the better guaranteed return, especially if your rate is close to or above what you'd expect from the market. This is why blanket advice on this topic is almost always wrong. The right answer depends entirely on one number you already have: the interest rate printed on your loan. Before you follow anyone's rule of thumb on this, including mine, go find that number first. Priya and Marcus both buy houses the same year, same mortgage, same rate. Priya throws every spare dollar at extra principal payments. Marcus invests the same amount instead, making only the required mortgage payment. 15 years later, Priya owns her house outright. Marcus still has a mortgage balance, but his investment account is worth more than what's left on his loan, combined with what he still owes. On paper, Priya feels ahead because no mortgage is easy to picture. But if you actually add up net worth, assets minus debts, for both of them, Marcus is usually ahead. Being debt-free isn't the same as being wealthier. None of this means paying off your mortgage early is always wrong. There are real situations where it's the better move, and ignoring them is its own mistake. First, if your mortgage rate is high, close to or above what you'd realistically expect from investing, the math flips. There's no gap to capture, so the guaranteed return of paying it down wins. Second, if having debt causes you real, ongoing stress that affects decisions elsewhere, that's a cost the math doesn't capture. Peace of mind has value. Just be honest about whether that's really what's happening or whether it's a story you're telling yourself. Third, if you're not actually going to invest the difference and extra cash just quietly disappears into spending instead, then paying down the mortgage is the more reliable path, even if it's not the mathematically optimal one on paper. There's one more variable that changes the math for some people: the mortgage interest deduction. If you itemize deductions on your taxes, part of the interest you pay on your mortgage effectively comes back to you, which lowers your real after-tax interest rate. A 4% mortgage might actually behave more like a 3.2% mortgage once that deduction is factored in, depending on your tax bracket. That makes the gap between paying down the mortgage and investing even wider in favor of investing. But here's the catch. Since the standard deduction increased significantly in recent years, most homeowners in the U.S. don't actually itemize anymore, which means this deduction does nothing for them. If you're not sure which category you fall into, check your last tax return. If you took the standard deduction, ignore this section completely. Your mortgage rate is your real rate. Full stop. So what do you actually do with this? 3 things. 1. Find your actual mortgage rate and compare it honestly to a realistic long-term investment return, not an optimistic one. If your rate is meaningfully lower, the gap is real. 2. Make sure you're actually capturing that gap. Extra cash sitting in a checking account isn't beating your mortgage rate. It only works if the money is actually invested. 3. Don't treat this as all or nothing. Plenty of people split the difference. Pay a little extra on the mortgage for peace of mind, and invest the rest to capture the gap. You don't need to pick a side completely. Let's make the hybrid approach concrete, since most people land somewhere in the middle. Say you have that same $500 a month of extra room. Instead of picking one side completely, split it. $200 toward extra mortgage payments, $300 invested. You'll still pay off your mortgage meaningfully earlier than scheduled, just not as early as the all-in version, and you'll still build a real investment balance over the same 20 years, just smaller than the all-in invested version. What you get in exchange is something the spreadsheet doesn't measure well. You're not betting everything on one side of the math being right, and you get to feel progress on both fronts at the same time. This isn't the mathematically optimal split. The optimal split, on paper, is almost always closer to all-in on whichever side has the better expected return. But optimal on paper and sustainable in practice aren't always the same thing. And the version you'll actually stick with for 20 years beats the perfect version you abandon after 2. Here's a 3-minute checkup you can do right now. Pull up your mortgage statement and find your interest rate. Write it down. Now compare it to 7%, a reasonable long-term average for a diversified index fund. If your rate is well below that, any extra money you're sending to your mortgage is money giving up a better return elsewhere. This isn't about telling you to stop paying off your house. It's about making sure that decision is actually a choice, and not just a feeling you never questioned. If you're watching this and you already paid off your house early before ever hearing this math, don't panic and don't feel like you made a mistake. A paid-off house is still a real, valuable asset, and the peace of mind is worth something even if it's hard to put a number on. What actually matters now is what you do next. With no mortgage payment, you likely have more free cash flow every month than most people. The question is whether that money is now going to work somewhere or just quietly absorbing into a slightly more comfortable lifestyle. The version of this mistake that actually costs you long-term isn't paying off the house. It's paying it off, and then not redirecting that freed-up payment into investing afterward. That's the step most people skip. Being debt-free feels like the finish line. Sometimes it is. But sometimes it's just the more comfortable-looking option, not the better one. Next time, we're looking at another number people love to celebrate, right before it quietly stops helping them. If this changed how you look at your own mortgage, subscribe. This channel is built for exactly this kind of patience.